June 2012, number 3, Portsmouth Home and Office Depot. Okay, so they present us with trial balance and they give us some adjustments to make. So the first step we'll do is on our question paper, we'll make some adjustments to the trial balance. So the first thing is, let's go through the adjustments. So the first adjustment, ending inventory is valued at 60,000, so we know that this will be our closing stock. There's no adjustment really to be made there. We'll just know that that's our closing stock. Invoices for utilities not received is $12,000, so it means that our utilities will increase by $12,000. So please note that this is in thousands of dollars. So utilities would increase by 12,000. So if we increase any debit side by 12,000, we need to increase the credit side. So I'll just use this side here for space and continue the accounts coming down. And so that 12,000 would be money we owe. So we would now have an accrual for utilities for 12,000. So therefore our trial balance continues to balance. Okay, so we've dealt with this, Insurance expense excludes $2,000 for July and August. Insurance expense includes $2,000 for July and August 2011, and July and August is not within our year end. Our year end is the 30th of June. So if it has $2,000 relating to next year, it means that we have to take it out. So we take out $2,000, we'll decrease that by $2,000, and we've decreased the debit side. We're now going to have a prepayment for insurance of $2,000. So our debits and credits will continue to balance. So we've dealt with that. Fittings are to be depreciated at 25% per annum using the reducing balance method. So reducing balance means we're going to use the net book value. So the net book value in this question would be 226 minus 88 to get the net book value. So we say 226 minus 88 and we'll get 138,000 as the net book value. Right, so when we take 25% of that, we will get 34,500. So our depreciation for fittings and furniture, the accumulated depreciation would increase by 34,500, and we would now have the depreciation for this year. So that's the expense. So depreciation expense for fittings would be 34,500. That's done. Next one. Buildings are to be depreciated at 5% per annum on the original cost. So we're looking at 5% of the original cost. So 5% of 592 is 29,600. So our accumulated depreciation will go up by 29,600. And we have an expense for depreciation for buildings being 29,600. Land was valued on 30th of June 2011 to 200,000. So the land is now 188 and we're going to bring it to 200,000. So it means then that we are going to increase this. We are going to increase this by 12,000. So we now have a revaluation reserve of 12,000. So we've increased the debit by 12,000, we increase the credit by 12,000. Done. 10,000 of the long-term loan is due to be paid in the next accounting period. So long-term loan, 10,000 of it. So it means 30 will be long-term and 10,000 would be short-term loan. So that's done. And tax has been calculated at 40,000 for the year. So therefore we have a tax expense of 40,000 and we have tax payable, because we haven't paid it yet, it's just been calculated, of 40,000. So now that we've passed all the adjustments, what we're going to do is we're going to create the income statement and the balance sheet as required by the question. So we'll just go through all the different accounts. We have a balance, trial balance, and we'll go through the different accounts and decide where each account will go. So fittings at cost, balance sheet, balance sheet, balance sheet, balance sheet, balance sheet. All these are fixed assets. Bank is balance sheet. The opening retained earnings goes in the statement of retained earnings. Long-term loan, balance sheet. Loan interest, short-term loan, balance sheet. Loan interest, income statement. Dividend paid, statement of retained earnings. Sales income statement, return inwards income statement, wages and salaries income statement, insurance income statement, utilities income statement, opening inventory income, allowance for bad debt goes in the balance sheet. It is only the increase or the decrease will go in the income statement. Administrative expenses income statement, purchases income statement. Discount received income statement. Accounts payable balance sheet. Accounts receivable balance sheet. Directors fees income statement. Ordinary shares balance sheet, and share premium account balance sheet. And these accounts we created here, accruals will go in the balance sheet. Prepayment, the prepayment will go in the balance sheet. These depreciation expense will go in the income statement. Revaluation reserve is the balance sheet. Tax expense is the income statement, but tax payable is the balance sheet. So now we know what all the figures are and we know where all the accounts are going. We can now create a balance sheet and an income statement. Okay, so let us create the income statement. As you sit to view this, please ensure that you have the adjusted trial balance in front of you. Please pause the video and try the income statement for your own self and then compare it to the answers received here. So the first thing you must make sure you do is you have the heading Portsmouth Home and Office Depot. Income statement for year ended 30th June 2011. Revenue. Okay, so most of you all are able to do this. Sales, less return inwards, and that gives us our net sales. Then less cost of goods sold. So we start off with the opening stock, which we get from the trial balance. Add purchases. Less discount received. Less closing stock. $60,000. That gives us a cost of goods sold, which gives us a gross profit of $606,000. Now we're going to less operating expenses. We have wages and salaries, insurance, which was 14,000 minus 2,000, utilities, 70,000 plus 12,000. Administrative expense, 64,000. Directors fees, 56,000. Depreciation for fittings, 34,500, and depreciation for building, 29,600. So our total expenses will be 422. That's operating expenses, which will give us 183,900, and that is our profit after operating expenses. Then we have other expenses and revenues, and under that we have loan interest, and we have loan interest of $4,000, and that brings us to 79,900, and this is our profit before tax less tax expense, which is $40,000, and that will give us this is 179. So, and this is our profit for the year. Now, before we can do the balance sheet, what we have to do is a statement of retained earnings for the year ended 30th June 2011. Okay, so we put in the heading as usual. So, Portsmouth, home and office depot. And now we're doing the statement of retained earnings for the year ended 30th June 2011. And we start off with the opening retained earnings. Which we get from the adjusted trial balance. Add the income for the year, which we get from the income statement. $139,900. That gives us $243,900. Less dividends declared, which would be $20,000, which will give us $223,900, which is the figure that we will put as our retained earnings in our balance sheet. Once they ask for an income statement followed by a balance sheet, you have to automatically know that you have to do this short statement so that you can get the retained earnings to put into your balance sheet. Okay, so let's have a look at the balance sheet now. So we start off with the heading, Portsmouth, home and office depot, balance sheet as at 30th June 2011. And as you're accustomed to, we have 3 columns, and for the fixed assets it will be cost, accumulated depreciation, and net book value. So in this question we have fittings, which cost us $226,000. Our depreciation, because we add on the depreciation for the year, and that gives us a net book value of. Then we have building, which is $592, and our total depreciation to date so far, and that gives us 514,400. And we have land, which is now revalued to 200,000 with no depreciation, and that gives us 1206, a total depreciation of 200, and our fixed assets of 817,900. Then we go to current assets. Oh, sorry, this heading here should have been a heading here, fixed assets. Then we go to current assets, stock debtors, bank cash, as you learned from Form 3. So our closing inventory was 60,000. Then we have accounts receivable of 256,000 less provision for doubtful debt, which is 8,000, which gives us 248,000. Then we have bank, 30,000. We have prepayments, insurance, $2,000, and that gives us current assets of 340,000. Okay, so now we're going to go to current liabilities. So our current liabilities, we have the tax payable, 40,000. We have the current portion of the long-term loan, $10,000. We have accruals, 12,000. Accounts payable, $200,000, and that gives us total current liabilities of 262, which gives us working capital, which is current assets minus current liabilities, of $78,000. Add that to our fixed assets, and we get 895,900 less long-term liabilities, and under this we have the long-term loan, 30,000 $865,000, which gives us 865,900. And this is financed by we have ordinary shares, which is 570,000. We have share premium, $60,000. We have the revaluation reserve from when we revalue the land. That would be $12,000. And we have our retained earnings that we get from our statement of retained earnings, and this is why we did the statement, so we'll know what figure to put here. And we get 223,900, and that gives us a total of 865,900. So our two figures balance, see here and here, so our balance sheet balances. And that concludes May 2012 Portsmouth.